Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, January 29th. The AI sell-off reversed yesterday. Nvidia jumped nearly 9%. ASML this morning announced a set of better than expected quarterly results that could also help improve investor sentiment. But the news flow will be intense in the next few hours and things could change rapidly. So on the menu du jour, the Federal Reserve is expected to announce a no change to its rate policy later today, while the Bank of Canada is expected to cut its rates by 25 basis points today. And Meta, Microsoft, and Tesla, these companies are due to announce their latest quarterly results after the bell. Apparently, I wasn't the only one thinking that the AI sell-off triggered by DeepSeek news on Monday was overdone. Because investors rushed immediately back to the market yesterday to buy Nvidia shares at a discount. So there was a pretty strong dip buying below the $120 per share level there, and the stock price ended up closing yesterday's trading session 9% higher. As such, Nvidia amassed more than $300 billion yesterday and recovered more than half of the losses that it made on Monday's road. So the after hours was calm as well. As such, the Magnificent Seven stocks rebounded 3% on Tuesday. Nasdaq jumped 1.60%, and Apple, which was actually among the rare technology stocks that were cheering the cheaper AI and the cheaper chip news, rallied more than 3% on Monday and another 3% more than that even on Tuesday, while the global ex-uranium ETF recovered 1.77% yesterday after a Monday dump as well. Now, it looks like the first DeepSeek shock is now behind us without further damage until investors and the big technology leaders get more clarity on if and how DeepSeek managed to create a model this cheap, right? But no matter if DeepSeek's claims regarding the cost of its model are true or not, Monday's technology rout will taint this earnings season, and investors will be probably pickier about the AI spending announcements by the big technology companies. Because together, Amazon, Meta, Alphabet and Microsoft are expected to spend up to $300 billion in AI this year, while their earnings growth is expected to slow to less than 20% in 2025. And zooming into the fourth quarter, the Magnificent Seven are expected to spit out around 20% earnings growth last quarter, and that's down from nearly 60% printed the same time last year. Now, obviously, the comparison is tough, and the robust spending and slowing earnings doesn't necessarily bode well with investors and their appetite. And with the DeepSeek's help, the narrative this earnings season will probably shifting from how much the big technology companies should spend to get to the place where they want to be to how little they could eventually spend to get there. So, this being said, I still strongly believe that compromising quality for lower cost is not necessarily the best way to be and to remain a leader in such a fast evolving technology environment. But obviously, these big technology companies, investors will be saying the last word because they're the ones that are putting the money on the table. Now, speaking of earnings, ASML, another victim of the DeepSeek triggered technology sell-off this week, couldn't really rebound as successfully as its US peers did on Tuesday, but the company just printed a set of better than expected fourth quarter results before the bell in Europe, which could, help shrug off some of the DeepSeek dust at today's trading session. And today, after the closing bell in the US, Tesla, Meta and Microsoft will be revealing their own fourth quarter results, and hopefully they will come with some good news regarding their return on their AI investments to help soothing investors' nerves about the further and massive AI spending announcements that they will be making. So, strong results could eventually help improving appetite in these technology companies after a difficult start to the week, while any misstep will likely be hardly punished. So, expect high volatility after the earnings. Now, zooming out of the technology space, the US yields remain under pressure at yesterday's trading session as capital continued to flow into the safer US Treasury markets, as many investors out there simply prefer to stay on the safe side of the game instead of rushing in. The US dollar, however, gained, and it's gained on the back of Donald Trump's renewed tariff threats. So the tariff man reacted to the new Treasury Secretary Mr. Bessent's proposal of imposing a 2.5% universal tariff by saying, no, the tariffs should be much, much bigger than that. Obviously, they should be much bigger than that. I mean, no one will get all the headlines in the world by imposing a pool-looking 2.5% tariffs. I mean, make it 25, 50, 100%. There is no limit anymore, but people will talk about you. The problem is, the higher the tariffs that the US will impose to its partners, the higher the price pressures in the US will be. And it's up to Fed to clean up that mess and deal with it. So yes, ladies and gentlemen, the Fed members have been scratching their heads probably since yesterday, and they will be announcing their latest monetary policy verdict later today. Now, the Fed is broadly and highly expected to maintain its rates where they are at today's monetary policy announcement to give themselves and to investors some time to assess what to do next and what should be done next. So the US job market remains healthy, mind you, and the US growth remains robust. Earnings look encouraging. Consumer spending in the US is strong, and inflation is kind of giving signs of heating up again because the US headline inflation hit the 2.9% mark in the latest reading, and that's up from 2.4% printed earlier last fall, while core inflation in the US has slightly come down but proves to be very, very sticky above the 3% mark. But on the other hand, the latest consumer survey from the US show that Americans are losing confidence in their economy. They actually say that the jobs are now harder to get, that the income is expected to improve less, and that business conditions in the US don't look as encouraging as they did a few months ago. So the Federal Reserve is kind of stuck between a rock and Donald Trump. What the Fed President Jerome Powell will say today probably matters more than what the Fed announces in terms of rate policy. Before the Fed announcement of today, investors around the world are betting that the Fed won't be announcing its next interest rate cut before the May meeting. Now, a significant shift to the latter expectation should determine the overall market sentiment, the overall market mood. A dovish tone from the Fed today should further ease the US yields, while a cautious tone from the Fed members could revive the bond sell-off. The US dollar, on the other hand, could give back a part of Donald Trump-led gains with a supportive Federal Reserve statement, but the fundamentals of the US compared to the other major economies will likely remain supportive of the US dollar in the next few weeks, and the Trump tariff risks remain always tilted to the upside. But not surprisingly, note that Bloomberg just posted a chart on their website this morning showing how Donald Trump tariffs hit the US growth during his previous term. And they say that it will unlikely lead to a better result this time around because other countries won't sit turning their thumbs. But we will see what happens. For now, the things don't look good for anyone, really. Speaking of other countries, the Bank of Canada is expected to announce a 25 base point cut to its monetary policy rate today, and the European Central Bank will probably do the same thing when it meets tomorrow. The dollar CAD is consolidating a few pips below the 1.44 mark this morning at the time I'm talking here, while the divergence between the Bank of Canada and the US Federal Reserve is already mostly priced in. Any dovish comments from the Bank of Canada officials could revive the selling pressure in the loonie against the US dollar and support a further advance in the US dollar CAD toward the 145 psychological mark. In Europe, the euro appetite is losing its strength after the failure to pursue further gains above the 105 psychological mark. Now, technically speaking, there is an evening star formation that hints that the weakness in the euro could extend into the next few sessions of trading. And, well, that's obviously supported by the fundamentals because the eurozone's growth outlook is much less than ideal, and the European Central Bank has solid reason to sound supportive and even act. So, this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.